Welcome back to the deep dive. Our mission today, well, it's to cut through all the financial data, the reports, the calls, and really hand you the key takeaways from Bank of Maharashtra's Q2 and half-year results. That's for FY26 up to September 30th, 2025.
Right. And we've really dug into everything, the investor deck, the analyst call transcripts, the statements. This isn't just about listing numbers. It's about spotting the strategy, the decisions behind what looks like, well, really strong performance for this public sector bank.
Yeah, because there's this interesting tension, isn't there? How do they hit record profits, improve efficiency so much, but also tighten up on risk?
Yeah.
And even cut some funding sources. The material gives us that full picture, that 360-degree view we need.
Definitely. It will cover capital adequacy, asset quality, even the specifics of their branch expansion plans. This deep dive should make it clear not just what they did, but how they plan to keep it going.
Okay, let's unpack this. Right, let's start at the top, the headline figures. And honestly, they are pretty eye-catching. If you compare Q2 this year, FY26, to Q2 last year, net profit, it jumped 23.09%. That's 1,633 crore.
And that trend holds for the first half, too. H1 profit grew 23.11%, hitting at 3,226 crore.
Those are really stellar numbers.
They are, especially given the rate environment. But, the key thing is it's not just profit. It reflects real business growth underneath. Their total business, that's deposits plus loans, grew over 14% year on year. It's now over, 5.63 lakh crore?
And looking inside that, the loan book, their global advances, actually grew faster than deposits, right? About 16.8% growth there?
Yeah, 16.83% for advances versus 12.13% for deposits. So they're actively lending, pushing that CD ratio up a bit.
What gives them the confidence, you think, to lend so aggressively?
Well, look at their capital position. That's the key. The capital adequacy ratio, CRR, improved a lot. It's up to 18.13% now. And the core capital, CET1, that's strong too, at 14.05%.
Wow, 18% CIRAR. That's massive headroom.
Yeah.
So for you listening, what does that signal? Is it just conservatism, or are they expecting big growth?
It's probably a bit of both, but mostly I think it signals capacity for growth. It means they can absorb shocks, sure, but practically. They can expand their loan book aggressively without needing to rush for more capital. It gives them a huge advantage in this market cycle, real firepower.
And it seems like the market noticed. Management made a point of highlighting that S&P Global gave them a BBB stable rating. They specifically called it a 3 notches improvement over another international agency's rating. That's a significant external validation.
Absolutely. It confirms the path they're on. It shows the market sees them moving into a more stable, reliable category.
Okay, so stability looks good, profits are high.
Yeah.
But let's talk about how they made that money. How did they manage their core lending margins with all the interest rate volatility?
Right, the quality of earnings.
It boils down to efficiency and really tight margin control. Their net interest income, NII, basically the profit from lending versus deposit cost, grew a solid 15.71% in Q2. And the really crucial number, the net interest margin, or NI, it held strong at 3.85% in the quarter.
3.85%. And didn't they say that was above their own target? Their guidance was 3.75%, wasn't it?
Exactly. And they achieved this even with, as they put it, the full rate cut impact coming in completeness during Q2. That points to serious operational discipline.
You can see that discipline in the costs, too. The cost-to-income ratio improved, right? Down to 37.9%.
Yes, down from about 38.8% last year. I mean, for comparison, keeping NM in near 4% and cost-to-income in the high 30s, that's really efficient, even compared to top private banks. And that efficiency drives up their return on assets, the ROA, to 1.82%. They're getting a lot out of their assets. Okay, here's where it gets really interesting for me. That operational discipline is one thing, but what about how they're funding themselves? How do they keep that NIM healthy when deposit costs are rising everywhere?
The deposit strategy. It's all about their CASA ratio. That current and savings account deposits, that's the cheapest funding a bank can get. And their CASA share is still incredibly high, 50.35%.
50% CSF.
Yeah.
That's just phenomenal. Didn't the transcript mention the industry average has fallen sharply?
It has. Management noted the industry average dropped from maybe 44% down to around 37%. So maintaining 50% gives a BOM a huge cost advantage. Massive.
It's a structural edge. But what was that strategic decision they made? The transcripts mentioned something about bulk deposits.
Yes, this is fascinating. They made a conscious choice not to chase or renew expensive bulk deposits. They decided to protect their margin, even if it meant letting some volume go.
That takes discipline.
Yeah.
Letting go of easy funding like that. Did they mention if it impacted their overall deposit growth?
Well, yes, their bulk deposit segment actually shrank by about 9.9% because they just refused to pay those really high rates for institutional money. Shows real focus. They did admit the overall cost of deposits ticked up slightly, maybe 6 to 8 basis points.
Okay, so why did it go up then, if they were cutting expensive bulk deposits?
Good question. They clarified it wasn't competitive pressure driving that. It was actually their own retail clients moving some money from low-yield CASA into term deposits. Why? Because those clients expect interest rates might fall later, so they're locking in current term deposit rates now.
Ah, okay, so it's customer behavior anticipating future rate cuts, not a sign their core CASA strategy is weakening. That makes sense.
Exactly. It confirms their low-cost retail funding engine is still strong, and that feeds right into their asset quality story.
Right. Let's pivot to asset health then. We know how they earn the money. Now, what about the risk in their loan book? High growth can sometimes mean lower quality.
Not in this case, it seems. The asset quality numbers show continued improvement. Gross NPAs, the overall bad loans, actually declined to 1.72% in Q2. That's down from 1.84% a year ago. And the net NPA, after provisions, it's tiny, down to 0.18%, basically negligible.
And what about provisions? How much are they setting aside, that provision coverage ratio, the PCR?
That's another really strong point. Their PCR is remarkably high, 98.34%. So for you listening, that means they've already set aside funds to cover almost 98% of their current gross NPAs. It's an incredibly safe position to be in.
Very safe. But we should mention, the auditors, while giving a clean opinion overall, did highlight two specific things in their report.
Yes, that's important context. The first one is a temporary but serious governance issue. They pointed out that the board had to use a special provision, para 14A of the nationalized bank scheme, to approve the results directly.
Why? What was the issue?
Because there weren't enough independent directors on the board at that moment, so the audit committee, which normally approves results, didn't have the required quorum to meet.
Okay, lack of independent directors for audit committee quorum. That's not ideal, even if temporary. How critical is fixing that?
Oh, it's absolutely critical. The audit committee's independence is fundamental for oversight. While the numbers seem sound, they need to sort that out quickly to meet governance standards.
And the second point, the auditors emphasized.
It relates to their provisioning. They noted the bank is still holding on to that 1,200 crore contingency buffer, the one set up way back during the COVID period.
So extra dry powder just sitting there.
Exactly. And that buffer becomes very relevant when you think about the next big regulatory change, the shift to expected credit loss or ECL provisioning.
Right, the ECL rules.
Yeah.
So what does this all mean? How are they planning for ECL where they have to provision for future expected losses, not just current ones?
Well, management gave an estimate. They think the total ECL requirement will be around 2,500 crore. But, and this is key, they have a long time to implement it. There's a glide path starting April 2027 all the way to March 2031. And they're already ahead, holding a 250 crore specifically for ECL right now.
So they feel they can handle the transition smoothly.
They seem confident. They calculate the extra quarterly provisioning needed during that phase-in, maybe 100, 125 crore, is manageable within their normal credit costs. No big shocks expected.
And presumably, their confidence comes partly from those stricter lending standards we talked about, that CIBIL score cutoff.
Absolutely. It links directly. They are actively de-risking, especially in retail. They stated very clearly, no underwriting in the bank below 681 CIBIL score for new home loans.
A hard floor. No subprime lending there.
None. And as a result, they said 27%, nearly a third, of their new home loan approvals in the last year were for customers with CIBIL scores over 800.
Wow, 27% in the 800-plus category. That's not just lending. That's like strategic cherry-picking of the safest customers out there. What does that do for future risk?
It should make their retail book much more resilient in any downturn. They're building a portfolio designed to outperform. It lets them chase that volume growth we saw, but without compromising on the quality side.
Which brings us neatly to their overall strategic focus. RAM retail, agri, and MSME.
Exactly. RAM loans grew strongly, almost 17% year on year, and they make up over 62% of the bank's domestic lending now. Within RAM, retail is the powerhouse, growing nearly 38%.
And that huge retail growth came from specific areas, didn't it? Secured lending mostly.
Yes. Primarily gold loans up a massive 47%, vehicle loans up 49%, and housing loans still strong at nearly 29% growth. They're finding volume in segments they can control the risk in.
Okay, but there was one area that looked like an outlier on the NPA front, agriculture. The agri-NPA was quite high, wasn't it? Around 9.89%.
It was. And yeah, that number jumps out. It needs context, though.
So what was the explanation? Is it just bad loans in farming, or is there a strategy behind it?
Management said it's largely strategic, partly due to some classification changes, yes, but mostly because they're shifting their agri strategy. They're deliberately slowing down on the small-ticket KCC loans, the traditional production credit.
Keys and credit cards, right?
Right. And instead, they're focusing more on bigger ticket, what they call investment credit.
Investment credit, like what?
Things like funding for, say, gold storage facilities or rice mills. Bigger, more structured loans tied to infrastructure, which are generally easier to monitor and secure than small crop loans.
Okay, so shifting towards larger, potentially safer agribusiness loans.
Exactly. And for the smaller KCC loans, they're only pushing digitalization hard in states like Maharashtra, where the land records are already fully digitized. That reduces risk significantly. So that high 9.89% agri-NPA today, it's partly a result of this transition. They're accepting a temporary hit for what they see as a better long-term, higher quality agri book.
That makes sense. Oh, yeah. Now, alongside this lending strategy, there's that huge expansion plan, Project 321.
Yes. This is a really big move.
Yeah.
Project 321 aims to open 321 new branches over the next 18 months. But the really crucial detail here, this expansion is happening mostly outside of their home state, Maharashtra.
Right, that signals a clear ambition to become a truly national bank, not just a regional heavyweight.
Precisely. They mentioned using detailed data analysis right down to the PIN code to pick these new locations, these potential growth centers. They expect these new branches to be profitable quickly and drive growth nationally.
And technology must be key to managing that wider footprint efficiently.
Definitely. They mentioned several tech initiatives, a revamped mobile app using RPA bots, robotic process automation internally for efficiency. And also they've operationalized their unit in Gift City, the international banking unit. They're aiming for $1 billion in business from that IBU within the next year.
Yeah.
So global ambitions too.
Okay, so summing up, strong Q2, driven by efficiency, disciplined lending like that Sybil floor, and this big strategic push for national expansion.
Which raises an important question for you, the listener. It's about their future funding and, crucially, their ownership. The bank has board approval for a really big fundraise, 7,500 crore total, with 5,000 crore of that planned as equity.
But wait, we just said their capital adequacy, the CRAR, is already really high at over 18%. Why do they need such a large capital injection right now?
Because this fundraise isn't just about growth capital, it's tied directly to regulation and the government's stake in the bank. See, the government of India's shareholding has come down, but it's still at 79.60%. SEBI rules, the minimum public shareholding norms, require promoter holding, in this case the government, to be below 75%.
Got it. So they need to bring the government stake down by another, 4.6%? And this equity raise is the mechanism to do that.
Exactly. It allows the government to dilute its stake further to meet the NPS norms while simultaneously providing funds for that ambitious Project 321 expansion and other growth plans. So the provocative thought here is this. Keep an eye on how this fundraise plays out. How does the market absorb these new shares? And what does this final step in reducing government ownership below 75% mean for the bank's perception and its journey towards becoming this modern national player?
A state-owned bank navigating government shareholding reduction while pushing for aggressive, quality-focused national growth. That really is the balancing act for Bank of Maharashtra going forward. Fascinating stuff. That's all the time we have for this deep dive. Thanks for joining us.